Greetings class and welcome to the Chapter 11 Foundational 15 video. In this video I'm going to go over the Chapter 11 Foundational 15 problem and walk through all the steps that are needed to solve that. And I'm here in Canvas to show you that these documents have already been uploaded. You have the Chapter 11 handout. Wait a minute, I'm in the wrong part of this. I'm sorry. I have the Foundational 15 Chapter 11 document here, and then the Foundational 15 exercise worksheet right here. So the Chapter 11 document will only be needed really to look at the questions that they're asking you, the 15 questions. The data for the problem I've copied over into the worksheet, so you can actually see here in the worksheet that I have the data that they're going to give you. Now, what I've done is I've copied it all over here. Westerville Company, and they have a contribution format income statement where they have sales, they have contribution margin, they have the fixed expenses and the net operating income, and average operating assets there. At the beginning of the year, they had this proposed investment opportunity would generate revenue of $200,000, contribution margin 60% of sales, fixed expenses of $90,000. The minimum required rate of return is 15%. And I'm going to come back to what this is, okay? We'll use this in a minute. We don't need that for the moment. But when we get to number 1, and we're looking at the questions, you can see that the first 3 questions are focused on last year's margin, turnover, and return on investment, ROI. So let's go ahead and do that. The first question is last year's margin. So we take the net operating income from here, the $200,000. So we just bring that down, and then we take the sales from here and we put that here, 1 million. And then we divide the net operating income by the $1 million, and we get 20% as the margin for last year. Next, we are going to do the turnover, so we're going to look at last year's sales, which we already have right here, this $1 million. So we put that in. And then we're going to divide that by the average operating assets here of $625,000. So we do that right there. And we get a turnover of we're going to divide 1 million by 625, and our turnover is 1.6, okay? Then for number 3, it asks what the return on investment is, and if you remember on Monday, the return on investment is simply the product of the margin times the turnover. So we have a margin of 20%. We have a turnover of 1.6, and a return on investment then is going to be the product of those two multiplied together, 32%, okay? So that's what we do here. Now for the next one, it's number 4 is where we start looking at the project itself. We're going to evaluate the project based on margin, turnover, and ROI. We're going to calculate those in 4, 5, and 6. So let's go back here. The first thing that they ask us for here is net operating income. And if you've been reading the data and the problem, you'll notice they don't give us net operating income on the project. So we have to calculate it using a contribution format. So we have projected sales of 200,000. We have a contribution margin ratio of 60%. So we're going to put that there, and we're going to multiply the 200,000 times actually 0.6, which is the same thing as 60%. And we wind up with a contribution margin of 120,000 right here. Then we're going to bring over the fixed expenses of 90,000, and then we subtract out the 90,000 from the 120. We get our net income for this is going to be $30,000. So that's the net income that we need. Actually, we had to calculate it because they didn't give it to us here. This would be the net income of the project. So we'll go down to number 4 and we'll say net operating income. Well, we got to go down one more to do this. Net operating income here is going to be 30,000. Our sales is going to be 200,000. So when we calculate this, we get 15%. That's the margin that we're going to have based on our net operating income that we've calculated. Okay, so that's number 4. Number 5, they're going to say, okay, what is the turnover rate? Well, we have the sales right here of 200,000. And they ask for average operating assets. Now let me explain this to you. We're going to go up here and consider this $120,000 to be the average operating assets. That's the investment that's required, and if we are investing that much money into this project, we're assuming that that's going to be used for the assets, and so that's what we're going to do here in this problem. So we come down here to number 5, and we identify the average operating assets as 120,000 because that was our investment in the project. So we divide 200,000 by 120,000. And what I'm going to do here is a function in Excel that will round this off to 2 decimal places. So I'm going to round this calculation to 2 decimal places. So we have an average a turnover for the year of 1.67, okay? That's rounded. Okay, so that's number 5. And now number 6, I got to get over here far enough. Number 6 is going to be the return on investment for this year's opportunity. So we're going to take the margin that we calculated times the turnover rate. So if you remember, the margin was 15%. And then we're going to go to the turnover, and I'm going to use the rounded number, 1.67, because I want to limit the decimal places in my calculations for presentation, and basically I don't want to overcomplicate it. So we have 1.67, and now we're going to multiply the turnover times the margin to get an ROI of 25.05. Okay, so that's the return on investment for this project. Now, if I were rounding off this 25%, I would just say 25%. In reality, you're probably not going to, let me go ahead and do this. I'm going to do a round, and I'm going to round it off to 0 decimals for the percentage. Did the wrong thing. Instead of a comma, I put a period. Okay, we got it. 25%. So the return on investment is 25% for the project. Now, what they want to know in number 7, if we go back to this question, it says if the company pursues the investment opportunity and otherwise performs the same as last year, what margin will it earn this year? So we want to look at this overall. This is a margin overall. So we want to take the net operating income that was there for operations, and that's what we have up here in this. So we're going to take that net operating income of 200,000. We're going to add to it the net operating income for the project. That's the net income that we calculated up here as $30,000. We're going to use this number, okay? So we have 30,000 as the income for the project, and then we're just going to add those two together. And that gives us 230,000 as a net operating income. For sales, we want to go back to the operations that we had last year, and we're going to use the same number again, $1 million. And then we're going to use the sales for the project, which is 200,000. And we're going to add those together. And we get 1,200,000 as the total sales. We have net operating income of 230,000. So we're going to take the net income divided by the sales. We get a 19% as the overall margin. I mean, that's everything. That's a project combined with operations. Okay, so the next thing in number 8 that they ask us for, I'm going to have to go back here to get it, is if they pursue the investment opportunity, what will this year's turnover be? So we look at that here in the question. If everything stays the same and performs as it did last year, what will the turnover be for this year? So we want to go back here and assume all the same things. So we go back to what we did over here for sales. So we have 1 million in sales. We have a project sales of 200,000 right here. Now the thing that we need to include here are average operating assets. So we go up here to get the average operating assets for operations of 625,000. And we add the project's investment. Remember I said the investment could be considered its average operating assets of 120,000. So that's what we're going to do here. We add those together. We have 1,200,000 in total sales. We have 745,000 in total assets. So our total calculated turnover will be, and again, I'm going to round this thing. Just as a side note, if you ever want to use the round formula, it's a great way to simplify your worksheets. And here, because I'm doing a decimal, I'm going to use a rounding of 2. So we have a turnover of 1.61, okay? And if I were basically the way I would look at things and the way that I want to see them presented is that I would go ahead and round these off to 2 for decimals, 1 or 0 for percentages. So that's what we have. Okay, so 1.61 is a turnover. Now we come back here to the margin, and we calculated the margin up here. And it was rounded to 19.2%. So I'm going to take the margin here. I'm going to use, and by the way, this may sound arbitrary, but I'll tell you this. This is the solution, the official solution. If I were looking at this for rounding purposes, I would either use what they have here or 0 decimal places for a percentage. I would use 2 decimal places for anything that's written as a decimal. So we're going to put these numbers in like this. We're going to use the rounded numbers, And when we calculate these together, we're going to multiply them to arrive at a new percentage, and this will be, I'm going to round this one again to 1 decimal, the way they do in the solution here. So 30.9% is what we have as a return on investment for number 9. So we're basically going through the process of calculating the margin by adding together operations results and project results, and then calculating the total, the sum total. And here we round it because, well, I mean, like I said in the one above, I would round it off to 0. For a percentage, you can do that, or 1. So in the solution, they say 1 decimal here, so we're going to do that. Then for the turnover, because we've added those numbers together for sales and average operating assets, we get 1.61 rounded. And again, I would round all decimals to 2 spaces. That's a pretty standard use. So now we come up with, we're using the 2 rounded numbers, and I round this number off to 1 decimal, and it's 30.9%. Okay. All right, so that's number 9. Now here's the number 10. If we go back to this prompt, and I copied it into the Excel spreadsheet for this one, but basically for number 10, they're not asking you to calculate anything. So let's go back to the spreadsheet here. It says if Westerville's chief executive officer will earn a bonus only if her ROI from this year exceeds her ROI from last year, would she pursue the opportunity? Now here's, let's take a look. Remember, the ROI we have this year with the project in is 30.9. But if we go back to last year's ROI, we had 32%. So in this case, because her ROI drops, her calculation of her bonus, she won't earn it. So in this case, we can assume that the CEO will not want to pursue the project because with the project included, ROI decreases, making her ineligible for a bonus. Okay, so that's essentially that's the kind of answer they're looking for. Now the question is, would the owners of the company want her to pursue the investment opportunity? Now let's go back and take a look at the criteria they gave us for the owners. If you look at this up here, they say the company's minimum required rate of return is 15%. So in this case, you have a return of 30.9 right here. So if you have 30.9 and the company wants at least 15%, the company is going to say yes, we want to pursue this project. So the answer to part 2 would be yes, the company would want to pursue the project. Now this is the shortcoming of ROI. If you're looking at incentivizing an executive for increasing ROI every year, it's going to be very difficult to do for one thing, but they may turn down a project like this that would be lucrative and profitable if they went through with it. Okay, so let's take a look at number 11. Now we're getting to residual income calculations. So for number 11, they want to know what last year's residual income was. So they have average operating assets from last year. We want to go up here and pull the number from 625,000. That's going to be our number. So 625. Then we have a net operating income from last year. We have 200,000 from operations. Remember, we had up here, just show you where I'm getting it. Net operating income, 200,000. That's the number I want. And so what we need to do now is say, okay, we have a minimum required rate of return, average operating assets times 15%. So I'm going to take the 625 times 0.15, and I'm going to get 937,750. So what is the residual income? Well, it's going to be the net operating income minus the required rate of return. In this case, you have $106,250 is the residual income for last year. All right, let's look at number 12. And it asks us, okay, what's the investment opportunities residual income? Okay, the residual income for only the investment opportunity. Now remember, going back to this, we're looking at the initial investment in the project as the average operating assets. So we have average operating assets of 120,000 there. Okay, so we bring that down and say 120,000 is the average operating assets. We have net operating income from this project that we calculated up here, remember, of $30,000 right here. So we go back down and put that in as the net operating income. Then we have a calculation of the minimum required return. So we're going to take the average assets, operating assets of 120,000 times 0.15 or 15%. We get $18,000. So we have residual income of 30,000 minus 18 or $12,000. Okay, so that is the residual income for the project alone. And now for number 13, they say, okay, if the company pursues the investment opportunity, this year's residual income will be, and what they're really wanting us to do is like we did in the one up above where we had operations and then we also had the project by itself. So we're basically going to be adding together these numbers we had over here. So we have 625,000 plus 120,000. All right, so we're going to add 625 plus 120. So we get 745,000 as the average operating assets. And that's just going back to number 11 and 12 and taking those average operating assets and adding them together. Okay. Then our net operating income is just going to be the sum of these two as well. So we take the 200 plus the 30,000. So we take 200,000 plus, I didn't get enough zeros in there, one more, plus 30,000. And we get 230,000, okay? Now for this part, we're just going to use the percentage of 745. You can't really add those together. So we're going to do the calculation, 745 times 0.15. We get 111,750. We're going to take the 230,000 minus 111,750, and we have residual income for the total company of 118,250. So what they want us to compare number 14, so I hope that makes sense. I really do. These are the three calculations for residual income. We have last year's residual income, the project's residual income, and then the project and last year's residual income added together. That's considering that the current year operations does exactly the same thing it did last year. So now they want us to say, okay, well, can we compare the residual income with the investment opportunity, which is right here, the $118,250. And then the residual income last year is just going to be this 106,250. So we'll bring that over here, 106,250. And then we basically take the residual income with the project minus the residual income without the project, and we get an increase of $12,000 in residual income. Now it says if Westerville's CEO will earn a bonus only if her residual income from this year exceeds residual income from last year, would she pursue the investment opportunity? And the answer is yes. She would pursue the opportunity, or pursue the investment, because residual income will increase, resulting in a bonus. So that's the answer. Well, something like that. I mean, you use your own words or however you want to say it, but that's the gist of it. That basically, yeah, she's going to be doing that because it will make her residual income increase. Now, here's an interesting calculation. If the contribution margin of the company was 50% instead of 60%, what would that do basically to the average or the residual income? Average operating assets, we're going to look at this, and this is going to be just for the project. We're not looking at the whole company as a total, but we have the 120,000 in average assets. So for net operating income now, instead of calculating what we did before, we would have 200,000 times, let me do this over here. We would have times 50%. We would have a contribution margin. So we have sales. We have a contribution margin percentage. And then we have a contribution margin, okay? I'll just say CM, not CM percentage. And then we're going to deduct fixed cost. Okay, and in this case, our fixed cost, oh, wait a minute, we don't want to compare that. I'm sorry. I'm not going to do the whole calculation. Well, we do need to, yes, we do. Okay, I'm sorry. So the fixed cost will be 90,000. We do need to do the whole thing. We have a 90,000 fixed costs and a net income of $10,000. So we take the 100,000 minus the 90, we get net income for the project of $10,000. So we have here net income will be 10,000. So well, not there, here, 10,000. And notice what they're saying here in the formula: sales times contribution margin percentage minus fixed expenses. That's what it should be. So we get a total 10,000. Now, what's the minimum required return? Well, that's going to be the 120,000 times 15%, or 0.15. We get 18,000. So if we actually subtract this, we're going to get a negative 8,000 in residual income. So they're not going to pursue that if their contribution margin was 50% instead of 60. So that really concludes all of this work on the Foundational 15 for Chapter 11. If you have any questions about any of this or would like to talk with me on WebEx or any other way, please send me a note and I'll be glad to meet with you.